All right, macro shock investors, Dave here, and today we're staring down another potential financial earthquake. Just when you thought the AI rally had us on easy street, the market's fear gauge, the VIX, is knocking on the door of 24, and Wall Street is buzzing with whispers of cockroaches coming out of the woodwork in the regional banking sector. Is this a temporary tremor, or are we on the cusp of a deeper, more painful market correction? Stick around, because the fragility of this bull market is showing, and we need to break down what's really happening and what it means for your portfolio. Let's get straight to the facts. The markets took a hit to sentiment recently, largely fueled by a pair of troubles in the regional banking landscape. The S&P 500 dipped by 0.7% as regional bank stocks plunged after Zions Bancorporation and Western Alliance Bancorporation both disclosed problems with loans due to alleged fraud. Zions reported a $50 million charge-off tied to a loan, while Western Alliance cited a collateral dispute with a borrower and exposure to the collapse of First Brands Group. This isn't an isolated incident. It follows earlier scares with subprime auto lenders like Tricolor Holdings, which reportedly hit J.P. Morgan Chase with rising loan losses. This renewed bank volatility, as Bloomberg put it, comes after Jamie Dimon's infamous warning that when you see one cockroach, there are probably more. That quip sparked a debate about underwriting standards, particularly in the booming private credit space, with some rivals firing back that banks should look at their own books. Sinead Colton-Grant, CIO at BNY Wealth, highlighted concerns that underwriting standards might not have been as robust as they should have been due to fierce competition to deploy capital. Herman Chan from Bloomberg Intelligence further clarified that the loans in question for Zions and Western Alliance were non-bank loans, raising questions about the safety of such credit within the banking system itself. Meanwhile, the U.S. government remains in a shutdown, impacting economic data, and there's an ongoing discussion about U.S.-China trade tensions and the impact of tariffs. The reaction was swift. The KBW Bank Index, which tracks regional banks, dropped significantly, and the Russell 2000, heavily populated with smaller banks, was down over 2%. Investors fled to safety, pushing Treasury yields down and sending gold to new record highs. Despite these immediate concerns, some, like Margie Patel of Allspring Global Investments, argued that these are one-off events, not indicative of a systemic problem akin to the 2008 financial crisis. All right, let's get into the core of what this means for your money. While I couldn't find a specific, live polymarket contract directly predicting a systemic regional bank crisis for today, October 17, 2025, the broader sentiment from prediction markets and expert commentary in the news paints a picture of elevated but contained risk. Polymarket has, in the past, indicated recession odds, which were around 33% earlier in the year, and currently suggests ongoing market uncertainties like the U.S. shutdown dragging on. The dispersion, not collapse assessment of regional banks is a key input here, suggesting that while there are problems, a full-blown systemic crisis isn't the most likely immediate outcome. Based on this synthesis, I've outlined three distinct scenarios. Base case, continued volatility and sector stress but contained, 60% probability. The S&P 500 and Nasdaq will likely experience continued choppiness, characterized by periods of recovery followed by dips. We won't see a full-blown bear market, but sustained upward momentum will be difficult. Growth will be muted as investors remain cautious. Specific market sectors. Financials, especially regional banks. This sector remains in the crosshairs. Expect continued pressure on regional bank stocks like Zions and Western Alliance as they deal with credit quality concerns and potential further disclosures. Even larger banks like J.P. Morgan might see some impact from their exposure to private credit, but their diversified businesses will likely buffer the blow. The KBW Bank Index will likely underperform the broader market. Technology. The AI-driven enthusiasm that powered big tech could wane as investors prioritize stability over growth. While resilient, tech giants like Microsoft, NVIDIA, and even Apple could see their lofty valuations come under scrutiny. However, truly innovative AI companies might still find some support, as seen with Micron's recent pop. Consumer discretionary. With consumer sentiment potentially impacted by economic uncertainty and rising delinquencies in auto and credit card loans, companies like Lululemon, which recently saw a downgrade, could face headwinds. Higher-end luxury, like Coach, as discussed in the news, might be more resilient among affluent consumers, but overall consumer spending could slow. Materials energy, gold, copper. Gold will likely maintain its safe haven appeal and could continue its upward trend, as it has been hitting record highs. Other commodities like copper and nickel tied to economic growth might see mixed performance, reflecting the dispersion in the economy. Bull case, quick resolution and limited contagion, 15% probability. If regulators and regional banks swiftly contain the fraud issues and the broader credit market shows resilience, the S&P 500 could quickly rebound. The underlying strength of corporate earnings, as BNY Mellon's CIO suggested, expecting a strong earnings season, could reassert itself, pushing indices back towards recent highs. Specific market sectors. Financials. Regional banks would see a sharp recovery as confidence returns. Big banks, having proven their resilience, would likely resume their upward trajectory. Technology. The AI rally could reignite with renewed vigor, pushing tech stocks to new highs as growth narratives dominate. Consumer discretionary. Improved sentiment would boost consumer spending, benefiting companies across the sector. Materials energy. Gold's safe haven premium might diminish, but industrial metals like copper could rally on renewed growth optimism. Bear case, systemic crisis and broad market correction, 25% probability. This is the cockroach scenario, where the fraud allegations in regional banks prove to be just the tip of a much larger iceberg. Widespread credit deterioration and tightening lending standards could trigger a significant market correction, pushing the S&P 500 well into bear market territory, down 20% or more. We could see a flight from risk assets reminiscent of the dot-com bust. Specific market sectors. Financials. The regional banking sector would face immense pressure, with potential failures and widespread consolidation. Larger banks would also be severely impacted by credit losses and reduced lending activity. Technology. Even the most robust tech companies would not be immune. Valuations would compress significantly as investors shun growth for safety. Consumer discretionary. A significant economic downturn would crush consumer spending, leading to widespread declines in this sector. Materials energy. While gold might initially surge even higher as a safe haven, a deep global recession could eventually weigh on all commodities due to demand destruction. All right, so what am I doing with all this? Given the dispersion, not collapse message coming out of the regional banking sector, and the fact that we're seeing pockets of stress rather than a uniform systemic breakdown, my take right now is one of selective caution and strategic positioning. I'm not hitting the panic button and selling everything, but I'm certainly not blindly buying the dip either. I'm holding my core positions in high-quality, dividend-paying companies that have strong balance sheets and less direct exposure to the regional banking and private credit issues. I'm also watching from the sidelines in many of the more speculative, high-growth names, especially in tech, which have become accustomed to a flood of capital. Now, let's talk about the SPY technical analysis, because the chart is echoing the sentiment of consolidation and uncertainty. The analysis states that SPY is consolidating after a recent pullback, and to resume its uptrend, it has to maintain above 672. This 672 level is critical, folks. If we can hold above that, it signals that despite the regional bank jitters, the broader market still has some underlying strength and could attempt to move higher. It's a battleground right now. However, the warning is clear. If it breaks down, the supports at 630 and 610 are below. These aren't just arbitrary numbers. These are key psychological and technical levels. A break below 672 would likely trigger further selling, potentially testing 630. If 630 gives way, then 610 becomes the next major line in the sand. A move towards 610 would indicate a more significant loss of confidence and could accelerate the downside. I'm watching these levels like a hawk, ready to adjust my stance if the technicals confirm a deeper descent. My current strategy involves trimming some exposure in financial stocks that have high exposure to non-bank lending or are smaller regional players showing signs of stress. I'm also looking for opportunities in safe haven assets like gold, which continues to prove its value in times of uncertainty. I'm keeping a very close eye on upcoming corporate earnings from the broader market, as the lack of government economic data means corporate America's reports might fill the information gap for the Fed. What are you doing about these banking jitters? Are you buying the dip, selling, or staying on the sidelines like me? Let me know your thoughts and strategies in the comments below. And if you're getting value from this analysis, hit that subscribe button and ring the notification bell so you don't miss our next Macro Shock episode. Remember, this is not financial advice, just my analysis and personal take as Dave from Macro Shock. Investing in the stock market carries inherent risks, and past performance is not indicative of future results. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions.